Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we looked at the XLF. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a fig leaf trade in the XLF. The XLF is an ETF that tracks a lot of the financial companies. So I am highlighting the fig leaf here inside the options playbook. And I want to talk a little bit about the strategy that we picked this time around. We looked at a longer term, deeper in the money option contract, just buying a deep in the money call approximately 6 or 7 months ago on the financials, the XLF to be exact. And the reason why we just looked at buying a longer term in the money call was we had a different outlook in the marketplace as opposed to this time around. We were anticipating some rising interest rates, and a lot of the financials did pretty well going into the end or to the beginning of this year. And they've stalled a little bit at this point in time. And the concerns of inflation have kind of crept in. And obviously we have the geopolitical concerns still going on. So the market is having a tough time. Still see interest rates increasing going into the end of the year, but we're really more worried about the yield curve than anything as far as the financials are concerned. We're going to look a little bit at the yield curve and talk a little bit about that. My point is that the markets were a little bit more shaky this time around than they were the last time that we were looking at a deeper in the money call option. Now, as always, this is not meant to be a recommendation. Whenever we look at trades, either on the Stock Play of the Day on Tuesdays or the Stock Play of the Day on Overtime on Fridays, we're just trying to learn. And the biggest thing that we talk about inside my book, the Options Playbook, is that there's over 40 different strategies. And there's no golden book of answer as to what the best strategy is. We want to try to pick a strategy that fits our forecast for that time in the marketplace. So this time around, we did buy that leap option, but the financials were a little weak, and they're actually showing a little bit more weakness today. At the beginning of the week. So we actually did a fig leaf on this trade. And good thing we did, because the underlying market did go down in the XLF. And what that fig leaf has done by selling a call option against our long, deep in the money option contract is provided a little bit of protection, a little bit of a soft pillow to land on, if you will. And we went out further than time too, because we are looking for this interest rate increase as we go into the end of the year. There, anywhere from 5 or 6 different increases, depending on what analyst you're listening to, that the Fed may do to the Fed funds rate. That is definitely going to affect everything. So here's what the fig leaf was. It's an alternative to basically a covered call position where you buy the stock and sell the call. It's also known as a leveraged covered call, and we highlighted that on Tuesday's show. But we're going to buy a deep in the money call option. And when you say a leaps option, that means just longer term option. It's just a fancy marketing term Chicago Board Option Exchange picked when they first initiated longer term options, going out up to 2 years in time. But we're going to be buying that deep in the money leap. Strike is way down below where the underlying stock is at. So you're buying way more intrinsic value than you are time value. And then we're going to sell a shorter term out of the money option contract against that position. So let's see what the XLF has done since we talked about, since we talked about the paper trade on Tuesday. All right, so if I run to the Ally Invest charts, we see here that this is a 15-minute chart. We always do the show live, so we're dealing with live markets, which always kind of makes it a little bit tough because the valuation of the trade changes as we are talking about the paper trade. And here is where this was noon on Tuesday. 15-minute chart stayed fairly flat, little decent run up, but now this isn't a big, as far as point wise, we're going from 37 and a half, not even a full point, up to 38 and a quarter. But we did get up to 38 and a quarter. Underlying stock did come back down. And now we actually have a lot of weakness in the marketplace today. We're down around 36.50, but once again, it's still approximately 1 point below where we put the trade on. So because of that, it's good that we did the fig leaf, that we didn't wait. A lot of times when I'm looking at buying deeper in the money call options, just like buying a stock, very rarely do I do the trade and sell the call right away, mainly because I'm buying either the deep in the money call or the long stock because I do think it's going to go up at that point in time. What made me nervous about the XLF was the general market, not necessarily the sector, because we're trying to look for sectors that may benefit from interest rate increases. And also there's, that goes all the way back to even a couple of weeks ago when we talked about Dollar General. Dollar General, this just, I think yesterday, set a 52-week high. And that was an underlying stock that didn't mind inflationary pressures, right? It was a lower cost retailer. And because of that, that stock has done fairly well. Walmart has done fairly well. That recently hit a 52-week high. So we are seeing, it's a stock picker's market. And that's part of the reason why we did the fig leaf. But so you can say we were bullish, not as bullish as we were before, but a little nervous. So we sold that call against it. Now, I don't mind, I want to emphasize this, I don't mind if that's your strategy all the time, to buy the deeper in the money option as a surrogate for the stock and sell a call against it. You just have to be aware that I don't really want to be doing that around earnings per se, because I want to get some upside. So I'm going to pick and choose when I want to be doing that type of strategy. And obviously in this scenario, it helped out. We would rather have the underlying stock go up, and it was going towards that strike price, almost to the point where we might have thought about rolling that option contract because we had a lot of time. 39 is the strike that we sold, but now it's back down. So I would not have adjusted the trade at all. And that's what the stock play of the day overtime is all about. So let's look at the trade, let's see what happened, and then let's talk about what we might think about doing as the shorter term option reaches expiration. Okay, so here, let me run on over to the Ally Invest option chains. Okay, now I'm there. So here it is. XLF right now down 1.8%. So it's a fairly decent move in an ETF to the downside, right? Because most of the moves in ETFs are muted relative to buying a bank or a brokerage firm outright. So we're down 1.8%, about 69 cents on the day. The expirations that we chose, we went way out in time, and it's really to try to fit in potential Fed moves. So we went all the way out to 2023 in the January options, 273 days away. And we went deeper in the money. We talked a lot about the liquidity of the XLF, makes it feasible to do these longer term option contracts because it is a fairly liquid underlying. So you have fairly tight markets even in the long-term options. We then went to the 28-day expiration and we sold the 39 strike. Okay, so when we put this trade on, according to my screenshot, the midpoint was right around $4.95. That means that for every 1-by-1 fig leaf that we put on, otherwise known as a leveraged covered call, because when we put that on, $4.95 was approximately where it was at. If we could fill somewhere near the midpoint, our max risk would be $495 plus commission on that trade. All right, so I have the trade all set up, and let's see where it's trading at right now. So if we scroll down to the option strategy workbench, we see that we are down approximately on this trade. It looks like 50 cents. We're down 50 cents on the trade, which is a decent percentage as far as buying an option contract that was trading for, or buying a spread that was trading for $4.95. But one of the things that I did notice by doing this, and this is if I'm doing fig leafs where I'm actually selling the short-term option, I will usually address this as a swing trade. And when we sold that option contract, the midpoint was at 32 cents on this option. So we've made about half of that premium in a few days' time. So that has helped us. We would be down more, obviously, if we had just bought the option outright. So this has protected us. It's done its job. And we still have quite a few days remaining to expiration. So I may consider closing this out and then waiting and maybe selling that option contract a little bit later in time. I'd sell the same strike, maybe when it got back to another 35, 40 cents, and then think about selling that 39 strike option again. Or more than likely, what I would look to do, and I'm going to make this the official paper trade, I'm going to close this out. We don't usually have a paper trade on the overtime. We just talk about theory and thought and adjustments. But in this instance, what I would be doing right now, as of today, especially going into the weekend, is I would have an order in. I would go over to the right-hand rail. I'm going to hit close. And in our instance here, we sold to open one of the May 20 39 strike calls. It's trading around 15 cents right now. That means we sold it to open. So now if we want to remove that obligation to sell the XLF at 39, we do buy to close. So I would have an order in to work this trade, and you can pick the price, but I would be very comfortable if with this much time remaining that I could close that out at 10 cents and hence make around 22 cents on that one option contract that we've sold. We plan on selling a few more over the life of the option, trying to avoid earning situations. We're in the kind of in the middle of earnings. There's a few banks that are left, but most of the big banks have already announced their earnings. So this would be an order that I would have in for the day, just to close out this situation. And if it does close, well, heck, that gives me an opportunity next week to maybe try to bring in some more premium. And one of the things that we did talk about, and I'm going to close this right rail right now. One of the things that we did talk about is the amount of time premium that we were buying on the longer term option. We bought the 34 strike, that's right. And we looked over, if we look at the time premium in the put, it was a little bit less. Right now it's right around $2. If I recall, I think it was a little bit, yeah, it was around 177. In my screenshot, I can see that trade. 177 is where it was. So when we bought it, that's how much time value we bought. Ideally, with the fig leaf, I would like to keep selling calls until I brought in $1.77 and offset that time value that you have when you buy an option as a surrogate for owning the stock. Now, remember, we were thinking of buying 100 shares of the XLF. So we're going to buy one call option. We're not using the option as leverage. We're using the option as protection in this type of environment. We're going to limit our risk. Our risk is limited to $4.95. And in this scenario right now, we have, well, I'll put that trade back in. We have lost a few pennies on this trade. We're going to add the buy. And we're now trading for $4.65 net. Well, if we sold it out, it would be a net credit to the account right now. Okay. So that's how I would approach this trade. I'd be thankful that I sold the call. Obviously, you'd like to be correct on our forecast. And at one point in time, we might have been a little bit worried and might have thought about actually rolling the call option where you'd go up and out in strike when the stock got above 38. So if I get anywhere towards the 39 level, I am going to want to actually roll this position. I want to make sure I don't get assigned, because hence the name the fig leaf. We own something that acts like the stock, but we don't own the stock. So we say we're kind of covered. As far as the brokerage firm is concerned, we are covered. But if we get assigned, we're going to have to do something because we don't own the stock. We probably have to either sell our longer term option and then go out and buy the stock, or we could exercise our long-term option. But if we do that, we're going to lose the time premium, which I'm highlighting here on the screen on the actual put option. So we have to consider all those things when we're doing this. It's a little bit more maintenance than buying or than putting on a covered call position, otherwise known as a buy right. Now let's talk just a little bit. I'm going to go a little bit extended here and just talk about a couple of things that I couldn't get to on Tuesday's show because we ran a little bit long. But inside the Ally Invest platform, I wanted to highlight that we do have research on ETFs, like most brokerage firms would. And one of the things that I like the most is to go down and look at the top 5 holdings in the XLF. A lot of people might not know this, but Berkshire Hathaway is actually almost 14% of the XLF. We have, of course, a lot of the major banks, JP Morgan, Bank of America. They make up a very big percentage of all of them. But Berkshire Hathaway definitely leads the way. And one of the things about Berkshire Hathaway, so if you want to go in and look at, what might be dragging, what's not dragging in your ETF, this is one way you can. And Berkshire Hathaway has actually done fairly well relative to the other banks. It's more in the insurance space, and the insurance companies have done fairly well, and mainly because of the yield curve. The yield curve hasn't been the best for banks that deal in the money in large balances and have that ability to give little to people that have money market funds and then make a lot by going out in the long term. So I do actually have the Treasury yield curve. And this is just from an independent site. I don't have this capability inside the Ally Invest platform to track the 10-year versus the 1-year or the 10-year versus the 2-year as far as treasuries are concerned. And I just also wanted to highlight here that an inverted yield curve has predicted the past 7 recessions. We're not quite there yet, right? We are trading the 10-year versus the 1-year spread. It's not inverted, it's positive, which does help the banks. It's not as good as it was back in 2010, right? But it's still on the positive side of things. And on the 10-year to the 2-year, we're almost flat. So that's not necessarily a good thing as far as the banks are concerned, but there's going to be a lot of activity with Fed funds and yield curves going forward into the end of the year. So this is, in a way, kind of a safety play, hoping that we can get a little bit more expansion in this yield curve as the summer progresses. All right, so last thing that I have for you is the watch list. I actually made a financial watch list for you, and you can see a lot of red across the board as far as the financials are concerned. So the fact that we were in an ETF and that we did a fig leaf, you never know where the markets are going to go, really helped us out. Because if we did an individual underlying stock, this probably might hurt a little bit more. And the fact that we did that covered call and we gave ourselves a hedge, a little bit of protection, means we're not doing as bad as the individual stocks. We have a long time on this trade, and that was the outlook for the stock. It was not a speculative trade, just looking for a couple week move, or we probably would have had to adjust the trade or get out of it. We're going all the way out to 2013. So that's it for this edition of the Stock Play of the Day Overtime. If you would like to get alerts, please click the bell, click subscribe and ring the bell. Easy for me to say. And then you'll get all the alerts for all the stock plays of the day. And we'll see you next Tuesday for the next stock play of the day. Thanks for coming, everyone.